Hey, my fellow Americans. If you're collecting Social Security benefits or planning to retire soon, you'll want to pay close attention to what I'm about to share. The Social Security Administration has just announced some major changes that will affect millions of beneficiaries starting this January. These adjustments could either put more money in your pocket or leave you scratching your head, wondering why your benefits feel a bit lighter. Before diving into these crucial updates, if you're new here and want to stay informed about Social Security, retirement planning, and making the most of your golden years, hit that subscribe button and ring the notification bell. You won't want to miss our weekly updates that could help secure your financial future. You might be wondering why these changes matter. Well, whether you're already retired, approaching retirement, or even decades away from it, these modifications to Social Security will affect your financial planning in ways you may not expect. Trust me, some of these changes are quite surprising, especially the fourth one, which many financial advisors didn't see coming. Let's start with the most talked about change, making waves across the country. The Social Security Administration has announced a significant cost of living adjustment, COLA, for 2025. But here's the thing, it's not as straightforward as you might think. Unlike previous years, this COLA comes with some interesting twists that could affect how much money actually ends up in your pocket. This new adjustment is designed to help beneficiaries cope with inflation. But have you ever wondered how they actually calculate these numbers? The formula takes into account the Consumer Price Index for urban wage earners and clerical workers, CPIW, which tracks the prices of everyday items like food, housing, and transportation. However, some economists argue that this method doesn't accurately reflect the spending patterns of seniors, who typically spend more on healthcare and less on other categories. Speaking of healthcare, this brings us to our second major change, which directly affects how Social Security benefits interact with Medicare premiums. Many beneficiaries don't realize that their Medicare Part B premiums are automatically deducted from their Social Security checks. This year, there's a significant shift in how these deductions are calculated and applied. But before we get into the details, let's address a common question. Will these Medicare changes eat up all of my COLA increase? The answer isn't simple, as it depends on various factors, including your current benefit amount and when you started receiving benefits. However, what's crucial to understand is that the Social Security Administration has implemented a hold harmless provision, which prevents Medicare Part B premium increases from reducing your net Social Security benefit in most cases. There are exceptions, though, and understanding whether you fall into one of these categories could make a big difference in your monthly budget. Now, let's talk about something causing quite a stir: changes to the Social Security earnings test. If you're wondering what that is, you're not alone. The earnings test applies to people who claim Social Security benefits before reaching their full retirement age while still working. The thresholds for how much you can earn before your benefits are reduced have been adjusted, and these new limits might surprise you. But here's something many people overlook. These benefit reductions aren't permanent. Once you reach your full retirement age, your benefits are recalculated to give you credit for the months when benefits were withheld. Understanding how this recalculation works is essential for making informed decisions about working while collecting Social Security. The fourth change, and this is the one that caught many experts off guard, involves modifications to how Social Security credits are earned. To be eligible for Social Security benefits, you need to accumulate enough work credits throughout your career. The amount of earnings required to earn one credit has been adjusted, which could affect both current workers and those planning to return to work after retirement. You might be wondering, why do these credits matter so much? They are essentially your ticket to qualifying for Social Security benefits. The system requires 40 credits, or roughly 10 years of work, to be eligible for retirement benefits. But the way these credits are calculated can significantly impact when you qualify and how much you'll receive. The fifth change affects something called the Special Minimum Benefit, a provision that many Americans don't even know exists. This benefit was designed to provide adequate benefits to long-term low-wage workers. The adjustments being made to this provision could be a lifeline for certain beneficiaries who might otherwise face financial hardship in retirement. Now let's talk about how these changes might affect different generations differently. Baby boomers, Gen X, millennials, and even Gen Z will all experience these modifications in unique ways. For instance, younger workers might need to adjust their retirement planning strategies, while current beneficiaries might need to reconsider their budgeting approaches. Let's break down how these changes could impact your specific situation. If you're currently working and paying into Social Security, you may have noticed that your payroll taxes feel a bit different. That's because the Social Security wage base limit, the maximum amount of earnings subject to Social Security tax, has also been adjusted. But what does this mean for your future benefits? The relationship between your earnings, the taxes you pay, and your eventual benefits is complex. But understanding it is crucial for making informed retirement planning decisions. For example, did you know that your benefits are calculated based on your highest 35 years of earnings? This means that even a few years of higher earnings late in your career could significantly impact your benefit amount. One aspect that's particularly important is how these changes affect people who are planning to claim benefits in the next few years. The decision of when to start taking Social Security benefits remains one of the most important retirement planning decisions you'll make. These new changes could influence whether it makes more sense to claim early at age 62, wait until your full retirement age, or delay until age 70 for maximum benefits. Consider this scenario. Let's say you're planning to retire next year and start collecting Social Security. How do you determine the optimal time to claim benefits given these new changes? The answer depends on various factors, including your health, other sources of retirement income, and whether you plan to continue working part-time. An often overlooked aspect of these changes is their impact on spousal benefits. If you're married, divorced, or widowed, these modifications could affect not only your own benefits, but also any benefits you might be eligible for based on your spouse's work record. The rules governing spousal benefits are already complex, and these new changes add another layer to consider. What about those who are already receiving benefits? If you fall into this group, you might be wondering how these changes will affect your monthly checks. While some modifications will have an immediate impact, others might take some time to notice. The key is to understand which changes apply to your situation and how to adjust your financial planning accordingly. Something that doesn't get enough attention is how these Social Security changes interact with other retirement income sources. For example, if you have a pension, 401k, or IRA, how should you adjust your withdrawal strategy in light of these modifications? The answer might not be as straightforward as you think. Let's also talk about state taxation of Social Security benefits. While the federal government taxes Social Security benefits based on your combined income, state taxation varies widely. Some states don't tax Social Security benefits at all, while others follow federal rules or have their own systems. Understanding how your state treats Social Security income is crucial for accurate retirement planning. What steps should you take in light of these changes? First, review your Social Security statement regularly. You can access this information online through your My Social Security account. This statement shows your estimated benefits and earnings history, which is especially important to verify now that these changes are being implemented. Another important consideration is how these modifications might affect your long-term retirement strategy. Should you adjust your savings rate or modify your investment allocations? These are questions worth discussing with a financial advisor who understands both Social Security rules and comprehensive retirement planning. For those still working, these changes might influence decisions about continuing employment. The adjustments to the earnings test and credit earning requirements could make working longer more attractive for some people. But how do you balance the potential for higher benefits against quality of life considerations? It's also worth mentioning the impact on disability benefits. Social Security isn't just for retirees. The Social Security Disability Insurance, SSDI program is also affected by some of these changes, particularly regarding the calculation of benefit amounts and income limits for recipients who are able to do some work. As we wrap up this discussion, let's address some common questions you may have. How will these changes affect the long-term solvency of Social Security? What other modifications might we see in the coming years? While we can't predict the future with certainty, staying informed about these changes helps you prepare for whatever comes next. Remember, Social Security is just one piece of the retirement puzzle, but it's an important one that requires careful attention and planning. These changes, while significant, don't have to be overwhelming. If you take the time to understand how they apply to your situation and adjust your plans accordingly, you can ensure a more secure financial future. Before we end, I want to remind you to take action on your retirement planning. Don't let these changes catch you off guard. Review your Social Security statement. Consider how these modifications affect your situation and make any necessary adjustments to your retirement strategy. If you found this information helpful, don't forget to like this video and subscribe to our channel for more updates on Social Security, retirement planning, and personal finance. Drop your questions in the comments below. I'd love to hear your thoughts and concerns about these changes. Thanks for watching, and I'll see you in the next video, where we'll dive deep into another crucial aspect of securing your financial future. Stay informed, stay prepared, and most importantly, stay engaged with your retirement planning.